Arts is proud to present Practical Bookkeeping for Creative Artists. Our presenter tonight is Ms. Cristina Lopez. Ms. Lopez is the CEO at Lopez, Iwata and Associates, a Bay Area accounting firm that focuses on growing small businesses. So let's give her a round of applause. All right,
are you guys ready? So, once again, my name is Cristina Lopez. I'm from Lopez Iwata Associates. We're a firm based in San Francisco. Just a little bit of background about me. 7, 8 years ago, somebody asked, like, what is your favorite client? And I told them my favorite clients are lawyers and artists. So lawyers because, they have money to pay me. And then artists, like, I would love to help people to do what they love to do. So I got in touch with California Lawyers for the Arts, and it's been my 7th or 8th year teaching this workshop. A lot of things have changed. We're a little bit more high tech right now with all this gadgets, but we're gonna try to make it as personal as possible. Okay. Welcome. There's 4 topics that we want to touch today. So it's purpose of bookkeeping, bookkeeping theory, software, and bookkeeping process. Please ask questions if you have questions within the workshop. Okay. First, purpose of bookkeeping. So very obvious purpose is for tax preparation. So we have to have financial information so you can file your income taxes. So it's already July, so I'm assuming that everybody has filed their income taxes in April. And if not, September is the extension for businesses and October for personal. So just make sure of those dates. The other purpose is to identify areas of improvement. So besides having to file your taxes, you have to have timely and accurate bookkeeping information so you can actually identify areas of improvement. And these are the things that I want to focus on today. Okay. Next is preparing financials for financial institution. When we say financial institution, these are for when you grow your business and it's about time to get a loan or funding or business partners. You have to have proper financial statements so you can provide it to them so they can figure out, is this business viable for investment? Okay. So any questions? Okay. Theory. When you actually talk about financials, you have to understand this basic theory: cash versus accrual method. Okay. Cash method, income is recorded when cash or money is received. So when you actually receive money from your client, that's where you record income. Expenses are recorded when you actually pay your bills. So when there's a monetary exchange. Okay. This is usually used for your personal or smaller businesses. And normally, you use cash method when you file your taxes, because you only want to file taxes for money that you actually have. Okay? Versus accrual method. Accrual method, income and expenses are booked when they're realized. What does that mean? When we say realized, when you actually do the job. At this point, it doesn't matter if you've been paid or not. And expenses are realized when you actually incur it. So it doesn't matter if you pay them or not. For example, you did a photo shoot that you haven't been paid for in June. Okay? In June, you did the job, and with that photo shoot, you incurred certain expenses. There was travel expenses. Okay? More obvious expenses would be you purchased materials or you hired an assistant. Okay? Say travel, you already paid for. Okay? The materials that you use, you already paid for. But the assistant, you haven't paid for. So in an accrual method, even if you haven't paid for that assistant, that's already an expense. Okay? So cash versus accrual. Cash, there's a monetary exchange. Accrual, it's when you actually realize the income or expense. It doesn't necessarily have to have a monetary exchange. Okay? Here, it's used for financial analysis because it shows you like a straight line. It's like, how viable is this business? Because it shows, like, what does it take to actually generate this income? What are the actual expenses for it? Okay? To give you a little bit clearer picture, in cash accounting, let's say in January, you receive $100. Okay? And then you spend $50. So there's an actual monetary exchange. And then you say, like, okay, I have a profit of $50. Then the next month, you receive $150. And then you spend $50. And then you profit $100, and you go like, wow, I'm actually doing well with my business, right? And it should sound good if there's more zeros at the end, but like, let's say the third month in March, you actually receive $150, but bills started piling up. Collectors started, like, your vendor started calling you, like, hey, you have to pay this bill from January. So here, the expense is $350. And then you would see at the end, you actually lost $200. If you look at the whole 3 months, you actually lost $50. So using cash method is not really good for financial analysis because it gives you a skewed way of looking at your financials rather than accrual method. Okay? In accrual method, if you bill your client $150 and the expenses that is related to that period is $100, you profit $50. So you look at it and say, like, how do I make things better for my business? Maybe I should go out there, get more business. So when you try to go out there, get more business, next month you make $200. Okay? And then the expense related to it is $150. At the end, you make $50. So you go like, okay, I need to work a little bit harder to achieve my goal. So the following month, you bill $300. Expenses related to it would be $200, and the profit would be $100. With accrual method, it's actually a better way of analyzing your profitability. Other people would ask me, but like, how can I collect that money? So that's an operational problem. Like, you have to make sure in your operation side you collect money from your clients. So that's a different, you know, story. Other thing that we want to talk about is tax accounting versus financial accounting. Tax accounting is governed by the tax laws. We're talking about federal, state, and local laws. Okay, in tax accounting, if you talk to a CPA, they would recommend you file your taxes in a cash basis. Because with that, as I said in the beginning, you only pay taxes from the money that you actually have. This, once again, focuses on taxes rather than financial statements. Okay, financial accounting is governed by GAAP, generally accepted accounting principles. Usually, financial accounting is used for banks getting loans or other investors. Okay, in financial accounting, you use the accrual method because you compare things apples to apples. Okay, in financial accounting, there's not a lot of like, I want to show more money, so I'm not gonna pay my bills. Okay, I want to show less money, I'm gonna pay all my bills. In financial accounting, you cannot do that. Okay, so when they see how viable your business is, they actually look at it in the whole business performance. Okay, now we want to talk about the different tax forms. Okay, we're talking about this so when you talk to different people, you know what you're talking about. Okay, the first form is BOE, Board of Equalization. Actually, this Board of Equalization recently changed their name to the state of California, but it's still referred as BOE. So when you sell products, you charge sales tax. And I believe in San Francisco it's 8.25%, and here I believe it's around 9%. It's 9%, right? In Berkeley, Alameda County is 9%. So when you actually, if you sell something for $100, you collect $109. That $9 is not yours. It just passes through. Okay, so when you record it in income side, that $9 is not income. It's a pass through. Okay, so you never record that as income. Okay, so that's the Board of Equalization. And then you have your city tax and business license. So the city, it doesn't mean that you have a business. The city already knows that you're in business. You have to tell them. Okay, it's better to do things properly in the beginning because in my experience, I've worked with a lot of small businesses that they never told the city that they exist. 5 years later, they get a bill with penalties and saying like, hey, you've been in business for 5 years and you haven't paid your city tax. City tax is very small. So when you start your business, it's good to actually pay the city tax. Okay. Um, in San Francisco, city tax is a hybrid based on income and payroll. Okay, for a small business, it's very small because you don't have high payroll. In Alameda County, Contra Costa County, it's based on income. Okay, so there's a percentage of income that's where you pay your city taxes. Okay, county and property taxes is for unsecured property tax. Unsecured property tax is your equipment. Anyone here does printing and reproduction? No. Printing and reproduction. So all those printers, those are unsecured property. These lights, if you do photography, these lights are equipment. Okay, so it's for your big equipment, furniture and fixtures that are not attached to the ground. Okay, because when you own your home, you pay property taxes, but that's secured property. That's your home attached to the ground. When in business, it's called unsecured property tax. Okay, uh, going back to what I said earlier, once you're in business, you also have to tell the county, I'm in business. The city and county doesn't necessarily talk. Okay, you have to tell them so they can actually bill you for it. You know, it's like counterintuitive, but they don't talk. So you have to tell them that you're in business so they later on they don't come back and say, "Hey, you've been in business for 5 years, and I'm gonna penalize you for it." So these things don't talk. So just make sure that when you start, you go there and say, "I'm in business." Okay. DE9 and D9C, these are the state payroll taxes. So once you have employees, you're gonna get these forms. Once you have employees, I suggest that you work with a payroll company. Please do not try to do payroll on your own, okay? Because these are the things that have like really specific deadlines, and a lot of the small businesses that I've worked with have been penalized and penalized hard by the government because they did not pay their payroll taxes. And like this is like the hardest thing like to manage because they're small amounts, but you have the penalties are way higher than what you have to do. So I suggest to work with a payroll company, work with the bigger ones. They're they're actually cheaper than the smaller ones. Work with ADP, Paychecks. I'm not affiliated to anybody, but I would suggest that you work with these companies. EDD, EDD is the Employment Development Department. Okay, so once you have employees, you deal with the EDD. Okay, so DE9 and DE9C are the forms that you get from them, but the agency that you would work with is the EDD. Once you work with the payroll company, okay, they're the ones who can handle this for you. So BOE, city tax and county tax, you handle. DE9, DE9C, and the EDD, the payroll company will handle that for you. Okay. Any question? Yeah, go ahead. Yes, Alameda County doesn't necessarily know that you're in business. Yeah. So they don't necessarily talk. Sometimes when you get bigger they catch on, but that's the part when there's already like, hey, there's penalties to it. Okay. So if you know, make time for it, go to the county and do that. Go ahead. DBA,
Yeah.
doing business as.
Yeah.
So doing business as is like it depends on your client. If you're not running like an actual business,
Yeah.
most of the time you don't need to file.
Right.
If you're just contracting for one person, like a subcontractor. But when you're actually functioning as a business, you have to go to the city and say I'm in business. Because the problem is once you get big. Now when you say you're so small, you can handle like all of these. But once you get big, and I'm assuming we're all here today because that's the goal, it's better to have your ducks in place. So if you foresee getting more clients, I would go to the city. It's very little, $25. It's not a lot of money. In the idea of the government, a freelancer is not a permanent situation. Okay, a freelancer is just a temporary situation. Okay, but once you actually do it continuously, it's a business. So I would still suggest that you would go to the city and actually file a business license. Because once again, once you get big, that's where everything get a problem. It's only $25. You just have to invest your time in doing it. Okay? Does that make sense?
Yeah.
Go ahead. It's a percentage of income, but it depends on the how much income you have. The form is very simple, and we're talking about like, when you reach like $100,000, that it becomes like $250. So it's like on a level, it's very little compared to the headache that you will get after. You know. Okay. Any question? Go ahead. You file because so you don't have a BOE because you don't have a product. Okay. Right. You have to have a city tax because you're a business. But if you're like it's a business license, okay, so you have to do that. County tax, you just tell them you probably don't pay anything because it's a service, so you don't have equipment, but you have to tell them that, hey, I exist, so they don't go back to you. And then D9 and D9C, if you actually get bigger and you actually hire employees, let's say, like you're starting to teach other people, you have, like you start having employees, that's where you have all those other things. Okay, so Franchise Tax Board, so we know them, it's the California Taxation Agency. Okay, so for our personal taxes, like we deal with the Franchise Tax Board. So when your business taxes due, you deal with the Franchise Tax Board. The IRS, you will love these people because not only that they're the federal tax agency, they're also the federal payroll tax agency. Okay, so they do two things for you. Okay, Form 100, this is state business tax. Form 540 is the state personal tax. Form 940 and Form 941, these are payroll taxes, federal payroll taxes. Form 1040 is the federal personal income tax. Form 1120, this Form 1120 changes, okay? It may be 1120A, 1120, it's not always 1120. It depends on the type of business you're in. So this form is the federal business income tax. Okay, so all these things on the right side after the IRS. So Form 100, Form 540. Ideally, you work with the CPA to do that for you. Okay, Form 940 and Form 941, the payroll company deals with that for you. Okay, Form 1040 and Form 1120, your CPA would deal with this for you. So right now, everybody's filing a 1040 already, okay? Because everybody has to file their personal taxes. Next, we're going to talk about software, okay? Software, we're going to talk about QuickBooks Pro, QuickBooks Premier, and QuickBooks Online. I'm talking about QuickBooks because this is the standards right now. When you work with a CPA, they're going to go like, where's your QuickBooks file? When you work with like a bank, can you give me a QuickBooks generated financial statement, okay? QuickBooks Pro is usually a desktop version, very simple. In QuickBooks, you can actually have your expenses and income and expenses entered in the accounting system. QuickBooks Premier is used when you actually have more complicated accounting. Let's say you have inventory. Anybody here deals with inventory? No? So if you have like you print T-shirts or anything like that, usually you have to have QuickBooks Premier because that's a software that manages inventory. But right now, I see a trend, just like what we're doing right now with this, like online thing. A lot of people are using QuickBooks Online. So it's a new trend for businesses. A lot of people gear towards QuickBooks Online. In QuickBooks, they give you a set of chart of accounts. But I have a suggested chart of accounts here, okay? And let's go through it quickly, okay? A chart of accounts is a list of categories, not only to classify different items for your taxes, but also to actually put things in order so you can actually figure out where you're putting your money, how you're spending your money, okay? So if you look at the sheet from operating accounts to retained earnings, those are balance sheet accounts. And then from sales until the end, those are profit and loss accounts. A balance sheet, we're going to go through it, we're going to talk about it more later. A balance sheet is a snapshot of your business. Meaning a snapshot is like, in any given point, this is how much money you have. And then these are like things that people owe you, what you owe your vendors, and then what you own. So let's go through like these items, and I'm going to give you examples. Okay. So operating accounts, these are your banks and your checking account and your savings account. Usually, when you open a business checking account, the banker will always sell you a savings account. So most of the businesses right now have a checking and a savings account. And then petty cash, these are for paper money that you actually spend. Okay. Accounts receivable. This is the account what your clients owe you. So it falls under accounts receivable. Employee advances. When it comes to a point that you have employees, sometimes employees want to get an advance. So in your books, it should fall under a certain place. Prepaid expenses. The most common prepaid expense is insurance. Most of the time, you pay insurance in advance, like your liability insurance, you're paid in advance. Let's say you pay 3 months in advance, so it's always on a prepaid. Undeposited funds, this is just a grouping account. When you start using financial accounting software, you would see that when you receive a lot of checks from your clients and you deposit it all together, it shows in the bank as one deposit, right? This undeposited funds makes you identify those different vendors. So you group it together. So when you put it in the bank, you can still identify what they are specifically. Okay. Accumulated depreciation. If you have fixed assets, there's depreciation that relates to it. Computer equipment, furnitures and fixtures, office equipment. These are the things that you depreciate. The common question is, what is the amount that goes under this and not an expense? Okay. Normally, the amount that some CPAs say $500, some CPAs say, $1,000. With the current, like rate, I would say like let's be safe, and so $800, I would put it as an asset. Okay, because when you say like a computer that worth $500, it breaks in a year. You don't have to make it as an asset because it breaks in a year. Might as well expense it. If it's something that won't last for more than a year, there's no real use of creating it as an asset and depreciating it. You can just expense that item. Security deposits. So if you rent a place, just like when you rent your apartment, you put in a security deposit. Accounts payable. This is the line item for things that you owe. So when you owe your subcontractors, this is where it falls to. If you have a credit card, a business credit card, I suggest that a lot of small businesses, like they go to the banks, they're not offered or they don't qualify for a credit card. But for what I suggest to my clients, use one credit card solely for the business. Okay, so you can monitor it separately. Okay, so if you have two credit cards, make sure one is only for the business, and you can use it here. That's you can use it for the business, but solely use it for the business. Do not use your personal accounts there. Okay. Accrued payroll and payroll liabilities. So once you actually have employees, most of the time when you have employees, you don't pay them like, let's say, from the 1st to the 15th. You don't pay them right away on the 15th. You pay them like the week after or 5 days later. The reason being is like you actually want to make sure that you have enough money to pay them later. Okay, so accrued payroll. So you put the dates on when they work, but you pay them later. So this is just a pooling account for people that you're gonna pay later. Okay. The same with payroll liabilities. Customer deposits. Customer deposits, if a client pays you in advance, let's say for a photo shoot in the future, that's not income yet. It's just a deposit. It becomes income once you actually do the job. So even in cash or accrual accounting, a customer deposit is still a customer deposit. It's not income yet. Sales tax payable. So we file sales tax every quarter. Okay. So the amount that you receive for sales tax, you pull it to this account and you pay it later on. So when you receive, like what I said earlier, if you charge $100 and you receive 109 because you charge sales tax, that $9 goes here. The $100 goes to the income. Next, shareholder contribution and distribution. Contribution is your money, personal money that you put into the business. Distribution is the money that you take out of the business for personal use. Opening balance equity. So when you start your business, this is the money that you actually put in. Retained earnings. Retained earnings is income or losses that's accumulated over the years. So if you look at the valuation, you would see these are like the monies that, like, it's a compounded amount over the years. The next, sales. Okay, so from sales to the bottom line is the profit and loss chart of accounts. So sales is income. Okay, so whatever kind of income, I would suggest that you actually modify this specific to what you do. You know, if it's like, like consulting income, or like product sales, or product or services. So you can modify this to whatever income it is. Outside contractors, cost of goods sold. So these are directly related to the sale. So cost of goods sold is all directly related to the sale. For example, you are doing let's say, when you do graphic design and you don't have time and you subcontract your subcontractor goes to outside contractors' cost of goods sold because it's directly related. Most of the time, anything directly related to the income goes under cost of goods sold. Payroll, if you actually have employees, that's directly related to the income. So when this graphic design business gets bigger and you actually have employees, anybody that are graphic designers too are in cost of goods sold because it's directly related to the business. Okay? Travel, cost of goods sold. Let's say I'm going back to my example as a photographer. So when you're a photographer and you go to the job, that travel related to it is cost of goods sold because it's directly related to the sale. When you go to a job, that's directly related to the sale. We're putting it in the right place, so when you actually do an analysis of what you do, you can see what's directly related and what's not directly related to the sale, but still business related. So bad debt, like, I don't like to talk about this, but we have to. So bad debt is when you actually start working with clients and they don't want to pay you. It has to go somewhere. So this is the line item that it goes to. General administrative expenses, they're not necessarily related to the sale, but you have to have this to run your business. First, accounting and legal fees. So as simple as accounting and legal fees, when you actually use or you use TurboTax, that's already an accounting and legal fee. Auto expense, if you have a vehicle and any repairs, that's an auto expense. Okay, because a lot of people, they need their car to get to their job. Okay, bank service charges. A lot of businesses, a lot of banks, they would charge you, let's say, $12 monthly fee. But the more common one, and I think it's worth it, when you actually when they charge you $3 a month to get the copies of the checks that you send out. So I suggest that if you don't have that, it's worth it because they send you all the like in behind your bank statements, they have the copies of the checks. So when you get audited, you don't have to like dig through like a pile. Who did I pay? So it's usually $3 for the bank, and I think it's worth it. Building repairs and maintenance. This is for your office. If there's certain repairs, you deal with that. Contributions. When you make donations, like you make donations to Cal Lawyers for the Arts, that's a contribution. That's an example. Dues and memberships. So if you have a monthly membership for Cal Lawyers for the Arts, that's dues and membership. Go ahead. So let's go back, okay? So those are different. That's tax accounting. We're talking about financial accounting here. Okay. So when your business, for example, when your business then and you really want to make a donation as your business to a certain, like, a baseball organization or whatever, you have to, mark that expense in your books. Okay? And we're only talking about monetary donation here. I'm not talking about an exchange in service, okay? We're talking actual money out. Okay? So when there's an actual money that you give to people, that's where it goes to a contribution. Okay, go ahead. Like, there's really, it's about your company policy or how you do your business. So for me, it takes about like 2 years because, like, like other people, like, for a vocalist, if they don't pay you in 3 months, sorry, I already did my job. But like for other industries, it's longer. For others, it's less. You know, um, but it's at a point that you're not gonna be able to collect that money anymore. Like no matter what. Like, and a lot of other companies, they keep on trying to collect, but you go like, oh, they closed. Yeah, that's bad debt. So that's beyond. Sometimes it's beyond your policy. If a company that you work with closed, it's going to be difficult for you to.
So if a gallery closes down, that's
Yeah,
when bad debt goes.
yeah. When a gallery closes down, that's it's bad debt, and you can't get your artwork back.
Right.
Because if you get your artwork back, I'll go, okay, like we're done. Yeah. So yeah, that's bad debt. Licenses and fees. So this is your business license. Okay. Earlier we talked about the city. So this is your this is you know, usually licenses and fees. Is not your city tax. So for example, you're in an industry like law firms, like they have to have a license to operate. So that's where it goes. But if your business has to have a license, that's where it goes. Okay. Meals and entertainment. Meals and entertainment, general and administrative. Usually, when you have an office and you buy your office lunch, it goes to general and administrative. But if actually it's a meal with a client or a potential client, it goes in a different place. Okay, so it's more of an office expense here. Office equipment rental, we see less and less of this. Back in the day, there's more of these because like back then people rent big uh, copiers. Now nobody really does that anymore. Only like law firms does that, but now nobody does that. Office expenses. So if you have water service, it's an office expense. Like if somebody brings water to your office. Office supplies. These are your pens, papers, basic stuff, and then other costs. Sometimes you have like just random costs that it has to fall somewhere. Like you just put in other costs, G&A. Payroll. Payroll is for your office staff. That's not directly related to the product. Let's say you have an office admin, like you have a office assistant. You have So everybody goes to payroll G&A. Postage and delivery. So this is self-explanatory, like FedEx, USPS, UPS, they all go here. Professional development. So if you paid for a class similar to this is professional development. Publications and subscriptions. So your magazines, inspirational materials, they all go to publications and subscriptions. Rent, if you rent a space, that's it. Research and development, if you're trying to, a lot of chefs, they figure out different recipes, they go somewhere, that's research and development. Telecommunications, cell phone, landline, internet. I actually put internet here because usually they're in a bundle, so I just put everything here. Travel G&A. So travel G&A compared to travel cost of goods sold, that's going to the job. This one is for Clipper cards, BART. Utilities, if your rent doesn't include utilities, that's where it goes. So that's all your general and administrative expenses. Most of the time, a lot of people would tell me like, but Christina, I don't have this and that. Like for a business to function properly, you probably have some office supplies. You may not use every single item here, but you'll definitely use items in this chart of accounts. Okay, or else you're not a functioning business, especially in this next category, marketing and selling. Okay, for any small business, you should have most of the things here. Okay, so advertising, may it be Facebook advertising, may it be actual advertising, billboard advertising, you have to have a certain advertising expense. Okay, marketing expense. Gifts, there's a place if you have to buy clients something, client gifts, marketing materials, that goes falls under client gifts. Meals and entertainment, compared to meals and entertainment G&A, meals and entertainment here is when you meet up with clients or potential clients. This is where it goes. Merchant bank fee. Merchant bank fee is when you start accepting credit cards, the fee goes somewhere else. So I want you to visualize when you actually get money from your clients and there's a bank fee. Sometimes they don't deposit the whole amount to your account. Sometimes when you accept credit cards from your clients, the merchant already reduces the fee. If you do that, if you're doing that right now, call your merchant and say, "Hey, can you actually do that at the end?" Because they can actually pull that for you. Because it's hard to account for the actual money if they keep on reducing it by their merchant fees already. When they can do it at the end. Go ahead. So PayPal, not Venmo, but PayPal. PayPal reduces the fee for you. But I don't think PayPal can actually change it yet. So PayPal still does it per transaction, but if you use a merchant, like, if you use Bank of America merchant or different kind of merchant services, you can tell them to do it at the end. American Express, but Square, they don't. Square, they still take it out per transaction. Yeah, they cannot pull it. But once you get bigger, I suggest you work with a actual merchant because they're insured, they have everything, and it's cheaper. But going back, an example is Square, right? When you receive the money, let's say $1,000, and then they charge you 2%, income is still $1,000. Okay, income is not less than 2%. Okay, that 2% goes to merchant bank fees. So when you record your income, those are two separate things. Okay, income is not less. Okay, marketing and selling supplies, if there's supplies that you have for marketing, travel, marketing and selling, if you go to that business meeting or the client meeting, the expense going there should fall under this. Usually a lot of, like airlines, if you have to go to a conference that's related to your business, that goes to travel, marketing and selling. Interest income, if there's money in that savings account that the bank asks you to open, there is interest income. Other income, some people, like other people that I know, because rent is so expensive in the Bay Area, they sublease part of their office. That may be other income. Depreciation expense, that's, like depreciation from your equipment that we talked about in the balance sheet. That's where it falls under an expense. So an example of depreciation, for example, you bought an equipment for $5,000. Okay, that equipment is, and you're gonna use that equipment over 5 years. You don't expense that in the year that you bought it. You depreciate it about like $1,000 every year. So $5,000, get the next year, you expense 1,000. The following year, you expense another 1,000, because you don't expense the whole item if it's an equipment for the company, because you're using it over a span of several years. Interest and finance charges. So if you have a credit card and you have finance charges, that's where it falls. And then taxes, city business, income taxes, property tax that we talked about earlier. So earlier I talked about marketing and selling. Any business here has to make sure that there is a marketing and selling expense in any way. Advertising, meals and entertainment, because that's the only way that you can actually grow your business if you're going to keep on marketing. Okay? Back then, I had this client, just a story, that they were advertising in Howard Stern. Okay? And like that was a long time ago, and it was expensive. Okay? So they pulled out their advertising. Their income dropped drastically. So by putting things in the right place here, you can identify where am I spending my money? Like what are my marketing and selling efforts? So you can make sure that you keep the right marketing and selling efforts so there's continuous income. When I see clients that doesn't have marketing and selling efforts, sometimes you ask them, so how long do you want to do this? Okay? Because if you don't continue marketing, there's you don't know how long, there's no continuous income. Okay? Does that make sense? All right. Okay, so that's the chart of accounts. Later on, we're going to talk about it more and how it builds the prettier picture. Process. Different kinds of processes. Accounts receivable. Accounts receivable is the money that you receive. Okay? So I have a basic anecdote about accounts receivable. When you don't invoice and you don't tell people that they owe you money, they don't pay you. Okay? I had a student a long time ago. He was playing in a. He plays bass for a good place here in the Bay Area. I don't mention it, but he was playing for Yoshi's. Okay? And then it's like, oh man, Christina, like, client doesn't pay me. I said, did you tell them that they owe you? Oh, I did not tell them. So once they send them an invoice, right there and then, they gave them the money. All you gotta do is if you don't invoice, you don't get paid. Okay, believe me, you have to invoice your client. Okay, tell them I'm in business. This is not free. Accounts payable is for people that you owe. Your subcontractors, your phone bills, all goes under accounts payable. Payroll is where when you have employees, This is you have to have payroll. Okay. Another thing, once you're a corporation, you have to run payroll. It's a requirement. It may be only you or maybe like somebody that works for you, but once you're a corporation, you have to have payroll. And then bank reconciliation. Bank reconciliation, I could compare this to um, going to a restaurant. Okay, when you go to a restaurant and you look at your receipt, okay, you want to make sure that everything that is in there, is what you consumed, or else you go like, this is not my bill. And believe it or not, banks make mistakes. Okay, and in the years that I've been doing accounting and bookkeeping, I've seen so many mistakes. Like a bank would like deposit $50 for a $5,000 check. So if you don't compare your bank, like to the statement, you might be losing money there. Okay? Ah. This is a sample of a QuickBooks homepage. In QuickBooks, it gives you like arrows on the different activities. So let's start with create invoice. Create invoice is this thing here on the left side. So when you create invoice, the next step is you receive the payment. Okay? And then when the money is there, you record the deposit. So that's your accounts receivable process. Okay? Once a client doesn't pay you like several invoices, before receiving payment, you can send them a statement too. If you look at the drop down before receiving payment, you can send them a statement of, hey, these are all the invoices that you have not paid me for. So that you can give them a list. Okay? So that's your accounts receivable process. Go ahead. Yes. Yes, and usually grants and fellowships has a different process. Okay, so on top of just invoicing them, you have to fill up a certain form, but that form may be the duplicate of the invoice. Okay, so it might be an invoice in a different form. Okay, especially for like grants and fellowships, so it's still invoicing in different forms. Okay, so remember, always invoice. Okay, next, accounts payable process, enter bill, and then you pay the bill. Okay, so just a refresher from what we talked about earlier. Okay, in a cash method, okay, with a create invoice and receive payment, where is income there? In a cash method, when you receive the payment. Okay, but on an accrual method, when you create the invoice, that's where the income is. Okay, so in a cash method, enter bills and pay bills. Expense is when you pay the bill, right? In an accrual method, once you enter the bill, you're already posting your expense there. Okay? It doesn't matter if you pay it or not. Okay? Does that make sense? Accrual method, you post income and expenses when you actually do the job or incur the expense. It doesn't necessarily have a monetary transaction. So even if you're not paid or you haven't paid the bill, but you already did the job or you already received the bill, that's already an expense. That's already income and expenses. You use accrual method for financial institutions. So when you generate financials, it goes in a straight line. Okay? So there's no wiggle room. Okay? The good thing about QuickBooks is you do everything in accrual. So you can run everything in accrual and look at your profitability. Okay? But in one click, you can change it to cash and give it to your CPA. So that's the good thing about using a financial software. Okay? Believe me, I have no affiliation with the software, but I believe in it. Okay, so so it's really the industry standard. Everybody, banks, financial institutions, everybody uses QuickBooks. Okay, there's some proprietary things out there, but for small to medium, even large scale business, QuickBooks is the industry standard. Okay, so yeah, so everything you create an invoice, receive payment, go through the process so you can actually produce financials in accrual, and then when it's tax time, there's a button, you change it to cash, so you don't have to do two separate books. Like back in the day, I've also experienced this. Back in the day, you create ledgers, like handwritten ledgers of like income and expenses. So you don't have to do that. QuickBooks is very affordable, okay? Excel spreadsheet is not financial software, okay? So, so it's still manual, so it doesn't really create finances for you, okay? Bank reconciliation. You compare the bank statement with your QuickBooks account. When you actually compare your bank with your financial software, everything in your financial software should be reflected in your bank account and vice versa. The only thing that doesn't clear are checks, handwritten checks that you've issued, because that's on the other person's side. So when you issue a check, when I issue you a check, I don't know when you cash it, but everything else should clear the bank. Deposits should clear the bank, okay? EFT transactions should clear the bank, okay? And it's good to match that with your financials, because what if like the bank doesn't deposit the money or not the right amount? You have to call them in advance, call them right away, and make sure your money's in the bank. And also, if you know you spent something that did not clear the bank, I suggest to call them too and make sure that that's gonna go through, because you don't want these expenses to stop suddenly pop out like later on. And I've seen it. I've seen it that, oh, like the vendor's like, oh, I forgot to swipe your card for the past like 3 months, and then now this is like a $15,000 bill. Like, come on now, like. So it's good to do bank reconciliation so you can actually make sure that whatever you spend clears the bank. Because if not, there's a lot of surprises. So if you have a business account now, I already suggest that you actually ask them to close at the end of the month. Banks will do that for you. So you can actually, at the end of the month, after the first, you know, maybe the third, you get a statement and you start reconciling your account and matching up your expenses. So it's going to be a standard. I suggest that you update your books once a week or as often as you want, but the reconciliation happens once a month. Record keeping. Okay? So this is very important because people say like, how can I protect my company from an audit? You really can't. Okay? Audits can be random, but how to get out of it with flying colors is having a proper record keeping system. So people say like, how far can the IRS audit me? Like at least 3 years. People say 7 years, but seriously, they can go as far as they want. So you have to have proper record keeping so you can actually go through an audit with flying colors. We don't want this like receipt box. We want it in an organized manner. Okay? So this doesn't have to be like with it back in the day. I always say like you have to have this physical file with the changing times. Okay? You don't necessarily have to have this. If you have to scan it, just make sure you organize it properly. You don't want to scan everything and then just shoves it in one place. Okay? Okay. First thing, my first recommendation is the $3 to have the copies of your checks with your statement is worth it. Okay? So that's the first thing you do in your record keeping. And then make it in an organized manner. Put your bank statements, the deposit, different tax forms, your asset information, accounts payable. Usually accounts payable, it's good to have a physical file. So you put all the unpaid bills, and then once you pay them, it goes through the different alphabetical order. I suggest accounts payable is always on alphabetical order because QuickBooks does it on the categories. But once you click the category, you can get the vendor name, and then you can put it in alphabetical order. Um, there's really no use in putting different the categories in your bookkeeping file. If you have like your loan information and then other vendor information, these are not the bills. For example, a vendor has a contract with you saying like, if you pay in advance, you get 15% discount. That's the vendor information that I'm talking about here. Okay, and then customer information. If you have different contracts with your customers, you have to keep it. Most of the things here, like your bank statements, bank deposits, accounts payable, all of these you can purge at the end of the year. You can put it aside, you don't have to look at it. But like your tax forms, you have to keep it year after year after year. Okay? When I say purge, I'm not talking about deleting it or throwing it away. You can just put it aside, okay? Those are different things. But all the other stuff you want to keep it handy. the bank statement is not a substitute for the receipt. You have to have the actual information. Other people say, like, you know, the IRS says, like, less than $75, they don't ask for a receipt. But I suggest you're already there. So what I would do, for example, okay, this is like a standard that I do with my clients, okay? Any actual bills, I file it in alphabetical order. If you are lucky that you actually have a business credit card, okay, I'm gonna use that mainly for my business expenses. And that receipts, I'm gonna put monthly. Like, put it in an envelope, like January, all my monthly receipts, okay? But the actual bills goes somewhere else. Like the AT&T bills, the like subcontractor bills go somewhere else. But the credit card receipts for like Starbucks, whatever, parking, that can go in a monthly envelope. And put it aside, once you get audited, like, this is my credit card statement and these are all the receipts to it, like, so it helps you. Because as I said, like, nothing can really protect you from an audit, but having a good accounting system is the best protection. A good filing system is the best protection for your business. Photos are beautiful, okay? But where do you put it after? You cannot just take it.
You still have to file, yeah.
You have to save it in a proper place. So you can create a folder saying, like, January credit card receipts. So that photo has to be saved.
Yeah.
Okay, like, it takes so much time at going through all your photos, and like, it doesn't really make sense. You have to make those photos make sense. That's why I said it may be electronic or actually physical. Go ahead. I hope with the changing times that the IRS is going to catch on to, like, all this technology, because I've experienced it that a client scans everything and then go through an audit, we have to print everything. So so that's still how the audit works. It doesn't have, here's my thumb drive, look at it, IRS. That's not how it works. So it can take a place of the receipt, but once you have an audit, it still have to print it. Yeah. So, like, in my office, what we do is, like, we have this year's and last year's actual paper, and then 2 years ago it's all scanned. And I go, like, if we get audited by then, we'll print it. you know but that's what I do. Like, I just keep the current files, because of course, like, real estate in the Bay Area is very expensive, and to have all these boxes is just ridiculous. Okay, so that's what I do. Okay, yeah. But maybe, hopefully, soon they'll catch on and say, like, thumb drive and all copies would be good. Okay? Any questions about this file system? So this is just an example. Okay? This is a good tool for you for an audit. Next, we're gonna go through this quickly. Financial reports. We talked about the chart of accounts earlier, but the build is on the financial reports. Okay? Once you enter all that data, we want to generate two major financial reports. It's a profit and loss statement and the balance sheet. Profit and loss statement summarizes the revenues, costs, and expenses incurred during a specific period. So I call this a motion picture, like what happened in the beginning, and then it gives you what the ending. So on day one, I purchased this, and then this is how it affects my profit and loss statement. So it's all your income less your direct costs, general and administrative costs, marketing and selling, and then what's at the end. Compared to the balance sheet, a balance sheet only summarizes the assets, liabilities, and equity. So it's like a snapshot. When a person asks you for your balance sheet, it's only a day. Okay? So when you talk to financial institutions and say, hey, can you get your balance sheet? It's not a period of time. A balance sheet is always like December 31st, only one day. A P&L covers like January to December, like June 1st to June 30th. Okay, that's a P&L, but a balance sheet is only June 30th. Okay, it's only one day. Okay, give you an example of it's clearer on the handout, but if you look at the handout, on the left side would be an example of a P&L. Okay, and companies are taxed from the P&L. Okay, you're not necessarily taxed to the balance sheet, but financial institutions look at the balance sheet because this is the viability of your business. So you have to make sure you actually monitor two things. Okay, once you already do bookkeeping in QuickBooks, I would recommend that you actually run your balance sheet and your P&L on a regular basis. Ideally, after you reconcile your bank account. Why do I say that? Okay, because if there's something wrong with the balance sheet and the P&L, you can catch it right away. You know, you can compare it to like the previous month if there's a wrong data entry. Also, by looking at your P&L and your balance sheet, you can make better business decisions. With that, you use accrual method. Okay, where am I spending my money? Am I spending too much money on meals and entertainment? Am I eating too much without generating income for this client for this specific expense? So by looking at it monthly, you can make better business decisions, and you can use that. You can generate these financial statements using QuickBooks software. Okay, there's a report, and you can easily generate these statements. Okay, so you run these statements for two reasons: looking for mistakes, and for financial analysis. Okay, so hopefully we can get a more advanced class just analyzing the different like financial statements. Okay, so that's my last slide. So I'm open to questions. We can go back to anything you want. It can be specific to your business. I'm open to answering it. I like it. So usually like these kinds of software, I suggest to use for billing.
Okay.
For billing, but not necessarily generating your financial statements because it's not operational. So QuickBooks, when you see it, like you enter the bill and then you pay the bill. Compared to Performer Track, it's good for billing because it gives you all the time you spent and all this. So those are good for billing. And it's similar to different industries because other industries do, if you do like architecture, there's also a specific one.
Right.
But I only suggest it for billing, not necessarily for financial accounting, because QuickBooks is still an industry standard.
Okay.
Yeah, keep it. It's good for
Okay, I'll keep it.
yeah.
I'll stop saying it.
It's good. It's good for billing your clients. Any other questions? A business debit card is your checking account, right? Okay. So in terms of accounting, okay, it's more risky to use the credit card, the debit card, because you can do cash back and all those other things. Okay, so and in terms of like data entry, it's used, like in my profession, entering things using the debit card is like entering so many checks compared to the credit card that you can actually just enter. Like it's easier to monitor that. Um, I know a lot of new businesses could still not get a credit card, that you have to use a debit card, but once you get the chance to get a credit card, it'll be better.
All right. Thank you all very much for watching. And for all of you at home, please give a like and subscribe to our YouTube channel so we can launch a full-service live streaming channel soon. One more round of applause.
Thank you.
Thank you very much for watching. If you would like to see more videos by California Lawyers for the Arts, please like and subscribe to CLA's YouTube channel so we can provide full-service live streaming programs soon. Our channel will be producing videos that cover all kinds of artistic, entertainment, and intellectual property legal issues. You can also find our videos on Facebook and livestream.com.